Good afternoon and welcome to episode 8 of Flow Power's On the Spot. My name is Aidan Moore. You may have seen me if you've tuned in to any of the previous On the Spots. I'm back after a couple of weeks on the Pine and taking over hosting duties from Nathaniel, who's not on today, but I'm joined by an old friend, Alex Lehman. Welcome back, Lemo.
Thanks, Aidan. Good to be here.
Third or fourth time on the spot for you, so thank you for giving up some more of your afternoon to give us a bit of a look back on the wholesale markets for the month of May.
Pleasure. You know I like chatting data.
I've been putting Alex to work, creating some wonderful charts. So if anyone joined the April market look back about 4 weeks ago now, it'll be a similar sort of theme, looking at the wholesale market in review from the spot market perspective and also the forward market perspective, and a few interesting charts with a bit more detail in them this month. Yeah, look forward to jumping into them. A few housekeeping things. I think we typically run for about half an hour. Flick through your questions, your comments. If you've got different views to us in terms of what have been the interesting things in the wholesale markets over the last month or so, feel free to enter those into the chat box as we go. Usual plug: Flow Power is a NEM-based, East Coast-based electricity retailer. We do things a little bit differently here. We typically support customers to take access or have some access to the wholesale market. So I think after this update 4 weeks ago, we got a few questions around why the focus on the spot market. So here at Flow, our customers are somewhat exposed to the wholesale price, either through their load shape factor or their price efficiency factor, which you might have heard me talk about on a previous webinar, or through their absolute exposure if they're wholesale exposed. So that is the key reason why we'll focus on the spot market. But for those of you who typically think about a fixed retail deal or sort of a more typical contract model, the back end of the discussion around the wholesale market, the contracting market, will probably be more in the sweet spot for you. The slide we've got up at the moment, so we've sort of been picking off different topics as we've moved through the series on the spot, and so today we will be back to the wholesale market, and that dovetails into a bit of energy contracting as well. So without further ado, I'm going to launch the first poll question before I give the floor to Alex to run through what happened. And our first question is around, have we seen the bottom for wholesale prices this year? Answer it from, welcome your answers there. Obviously those markets are somewhat independent, linked but independent, so maybe the low could be in for one but not the other. We asked a similar question this time a month ago. What was your answer, Alex, a month ago? Can you remember?
I think I was expecting things to bottom out a little bit further, actually.
You're back in the start of May, end of April. You're still a bit bearish. We did ask the question around when will contract prices bottom? Had the bottom been in April? Was it going to be May, June, the back half of 2020, or did the long-term contracts have further to fall? Still give a couple more seconds for a few votes to roll in. Interestingly, back then, the split was, off the top of my head, only about 5% thought that the low was in for contract prices at the end of April. There was about a fairly even split between about sort of 15 to 20% in May, June, another 20 odd percent in the back end of 2020, and then the balance of respondents were thinking that the lows might be in 2021. So good to ask the question again. It seems like there's probably a bit bigger, leaning towards now that perhaps the lows are in either April or May, and perhaps we'll unpack some more of the drivers and those factors over the next half an hour. If you're still, a third of you are still fairly bearish, and 20% sitting on the fence, 20% don't know. So yeah, let's see if after today we can learn a bit more and anyone's view changes. So Alex, tell us, a couple of 2 months ago we were pretty worried about the sky falling in from a demand perspective for a range of reasons, particularly COVID and its impact or the restrictions we're having. But tell us, what did May look like?
Yeah, great. Thanks, Aidan. So we're going to do something a little bit differently to last time here. So here I've plotted the average demand throughout the day for each region. So there's 4 separate charts, and the 4 separate lines, different colors, we're actually looking at the different weeks of May. So week 19 is the week of May that started on the 4th of May, and the week 22nd is the week that ended on the 31st. So we can see some pretty interesting trends there, and they were pretty consistent across the entire NEM. So one of the key things we saw was much lower demand across every region in the first half, particularly that first week, with a very consistent trend upwards in demand across the day. So not just the peaks, but the entire days were lifted, which is, as it's getting colder this time of year, we'd obviously expect that. But some fairly sharp lifts in demand as we've seen some of that colder weather set in. Queensland's got quite an interesting change in the shape. We can see that the third weeks, that sort of the chocolate coloured line, was significantly shallower than the other 3 weeks of May. So we're seeing that deep duck curve in Queensland was really throttled back in the third week, which was, if you actually look at the weather patterns, there was a lot of cloud cover in Queensland in that third week. So that really takes that edge off that rooftop solar generation.
It's not people in Brisbane turning on heaters, is it, Alex?
It's not. It's still thongs weather up there, mate. And what we're also seeing is probably sharper peaks in the demand curve in the evening and morning intervals compared to April. So April, there's obviously still evening and morning peaks, but the May peaks are definitely a little bit sharper, which is quite interesting. We're also observing, if anyone can remember the May charts, we saw in a number of regions the midday demand was actually below the overnight demand, which is sort of unusual, and we talked about how the duck curve was deepening badly. We can see that that's really only the case in South Australia and Queensland, sort of marginal. So we're seeing more traditional, incredibly low overnight demand in New South Wales and Victoria with elevated demand in the middle of the day. That could be due to COVID, people working from home. It's a little bit hard to draw those precise conclusions from such high level data. But it's certainly interesting. The shapes have changed quite a bit from just a month ago.
There's lots of really interesting things to pick out of that, Alex, but that last comment that you made there around the duck curve being really deep still in Queensland, with the exception of week 21 there, or the third week of May, and South Australia relative to overnight demand, that has a whole bunch of knock-on effects from a market perspective, given that both regions here are at the ends of the NEM. They are therefore most likely the 2 regions most susceptible to negative prices and really depressed daytime prices as a result. And I think we'll see some of that on the following slides when we touch on price. But it's fascinating that those 2 markets on the fringes are also those with the deepest duck curves, because that, New South Wales, Victoria might be better able to absorb some of that and send that electricity into neighbouring regions. But when it happens at the periphery, that sets up the recipe for disconnection or between regions and obviously and negative prices, which is something that's been a feature of the market more and more so over the last months.
Yeah, absolutely. It's also interesting. We're still seeing, we saw some at the beginning of May. We're still seeing some system security constraints being enacted in South Australia. So gas-fired synchronous units are being directed on to run in periods of very low demand where there's high renewables penetration. So those asynchronous units are unable to support the inertia of the grid. So as that duck curve deepens, particularly deepens at all times of the year, then we're going to see more system security concerns, particularly in South Australia. Queensland's still got a fairly good base of inertia with all those coal units, so less of an issue at the moment. One thing, probably just to confirm, to note that we are talking about scheduled demand here. So the change in the shapes, don't take into account rooftop solar. That's why we're talking about this gap. So there's no estimate of rooftop solar. We're not seeing any behind the meter generation included, or estimates of behind the meter generation included in these graphs.
I think that the other thing that I find quite interesting is that Queensland step change, the difference between the cloudy week and every other week with solar cranking along. I mean, looking at that chart, there is circa 10% of regional demand. So, 500, 600 megawatts. I mean, that's pretty significant, and obviously depending exactly who's the marginal generator in one given week, it could certainly tip you over to a different technology type. Particularly more so as it takes hold in different regions. So yeah, fairly significant swings with and without renewables in a region, as we sort of know is having a greater impact. I suppose the other point to make here, Alex, by and large, we see so all three across the 4 weeks, demand picked up. Things probably got colder as we get a little bit closer to winter and have now started it, obviously. But what does this demand look like relative to history for the month of May?
Yeah, so obviously that data's we're not showing that data here, but if you actually compare this data relative to historically what other May data sets look like, where Queensland excluded, we're looking at some of the lowest demand we've ever seen for this time of year, which is something we explored when we talked about it last in April, about this continuing trend of reduced demand across the NEM in all regions except Queensland, where we're looking at as industry shuts down and as we see changes in people's energy efficiency behaviour, we do see reduced demand. Queensland stands out because it's got the very large LNG terminals, which have only been started in more recent years. So Queensland demand declined for a number of years throughout the NEM, but has since increased back up towards historically high levels. And that demand in that region is very consistent because those LNG units run more or less 24 hours a day, 7 days a week generally.
Yeah, so big picture, demand still fairly depressed outside of Queensland.
Yes, absolutely.
Let's take a look at the supply side.
Yeah.
Took the words out of your mouth, vice versa. Tell us.
So don't have quite as many lines here. So here we're looking at aggregated generation in gigawatt hours, so total generated output. The colors are the same, so we're looking at 4 weeks again. And here we've just broken up generation into sort of the 5 key categories. So we're excluding some of the smaller units and new players like batteries here. And we can see some of the trends that we explored in demand. So we saw that big change in demand in Queensland, where there was a change in the duck curve in week 3. And we said that was likely due to rooftop solar, but we can see here that there was also a clear drop in utility scale solar. Which obviously, if there's cloud cover over much of Queensland, then both of those types of generating assets are going to be affected. We saw quite a significant drop in wind. So these are NEM-wide figures in week 2, with what appears to be a corresponding uptick in coal-fired generation in that week 2. So there was a bit of an increase there. But what's quite interesting is we don't see any sort of week-on-week consistent changes in generation output to match that demand. We're not seeing one particular category of generation unit really stepping up. We see a bit of a slight increase in gas, which I think we sort of alluded to before about possible change in generation mix when we're talking about marginal bids. But there's no sort of huge changes. There's no category that's really driving those changes.
Yeah, so I suppose then, I mean, naturally those weeks as demand picked up across the month, if we're not seeing a major shift in generational mix, arguably we shouldn't see that significant a step change in price, obviously subject to generator bidding behaviour. Is that a fair sort of broad brush statement to make?
Yeah, I think that's fair. It's interesting. Some of the other observations we've seen, particularly in May, we saw a trend from April continued where Queensland coal-fired units are generating incredibly heavily, exporting. So the interconnector from Queensland to New South Wales has basically been permanently stuck facing south, exporting very large amounts of megawatts into New South Wales. We've actually seen anecdotal evidence that the New South Wales generators have had to reprice down to very low rates relative to their profit margins to make sure that they can run and that they're stable. And we've also seen a bit of an increase in Queensland gas generation. Something we talked a little bit about in April was the very low spot gas rates, especially relative to prices we saw a year or 2 years ago. So it's interesting to see the gas generators possibly take advantage of low spot prices if they're not contracted heavily.
Yeah, so you've still got spot gas prices in the $3 in Queensland, $4 in other regions, particularly where there's a bit more of heating reliance on gas as a heating fuel, like Vic and to a lesser extent South Australia. So yeah, that still is very, very encouraging for gas-fired generators if they can get their hands on that gas at those prices. Particularly, yeah, they can run at $40, $50 a megawatt hour and keep prices in check. So I suppose that the logical question from here is, did they keep prices in check for the month?
Let's have a look. So the headline for May, and in the headline of the slide here, is that prices are still incredibly low for this time of year. So I think we reported in April that we were seeing record, historic 4-year lows, and in fact, prices we saw in April were near the lowest for April in the entire history of the NEM. They're not quite the lowest we've ever seen for a May period in the NEM's 20-year history, but they are very, very low relative to what they've been in the last, sort of 4 or 5 years. What we've seen is, as we've seen the colder weather, that demand increase, we've seen an uptick in prices, and it's not quite as clear as the demand curve, but we can see a reasonable increase in prices week on week throughout May. So prices have been creeping up. Particularly observed in the last week of May, that week 22, all regions saw quite a large spike in the evening, sort of that evening price. So, that suggests
really
that
defined.
we're seeing, yeah, absolutely, and that suggests that we're starting to see some of those gas generators become the marginal bids and start to drive up the evening prices a little bit as they cover that demand, or hydro, as they cover some of that evening demand. If we look at the weather patterns over the last month, week 3 was quite a cold and cloudy and wet week in almost all the NEM to varying degrees, and we can see that increased prices correspond to that. So as we've got depressed solar, higher heating demands, then the prices creep up significantly relative to the other weeks. So it's quite interesting that there's not all of the year do we see very linear trends between demand and price, but we're seeing quite consistent trends in May between what was happening on the demand side and what we're seeing in the price.
Yeah, I think, again, remembering back to the previous slide around, or 2 slides ago, in terms of that demand in week 21, you can just see that daytime prices in all regions, as a result of that lack of solar, predominantly in Queensland, but potentially trickled into other regions as well, just lifted daytime prices to the tune of sort of $5 to $10, depending on which region and which axis you're looking at. And then obviously, clearly, that week 4 evening spike, and typically the winter months are more pronounced in terms of the morning and evening peaks, and so that sort of trend towards a 2 peak instead of a single peak like we might have in summer is something that we would expect at this time of year, but pretty fascinating to see it sort of play out progressively over a transition month like May, like you've been able to chart up here, Alex.
Yeah, one thing we can also see, we talked a bit about it briefly, but in South Australia, we're still seeing negative prices during the middle of the day, particularly that first week of May saw a good chunk of negative average prices. And then the remaining weeks sort of were just above zero, sort of in the midday period. Queensland was borderline negative in the middle of the day in the early weeks of May. So interesting that that trend from April was still pervasive in the early part of May. But perhaps the higher levels of demand during the day have driven, and the reduced availability of some of the renewable assets have increased those prices back above zero in the middle of the day in the later parts of the month.
I think, I mean, we like getting sucked into the details. Certainly you and I have gone back and forth plenty over the last few days around what we see in the charts, but ultimately, I mean, prices are still very depressed, irrespective of that transition between the first half of May and the end of May. Pulling up the numbers now, you've got monthly average price in Queensland in the low 30s, $31, up into Vic, South Australia and New South Wales in the high 30s, low 40s, still very, very depressed. Probably slightly higher than they were in April in all regions other than Queensland. But yeah, 3.5 cents, 4 cents a kilowatt hour for those of you more familiar with the prices in retail contract terms. Yeah, pretty cheap going.
Yeah, and we're seeing that continue, but into the the first couple of days of June. But what is interesting is for those of particularly our customers who are spot responsive, those evening peaks are starting to really show rear their head. We're actually looking today at possible $300 territory in the afternoon, which is heading towards sort of that summer-ish type behavior, but very low prices during the remaining of the day. It's currently in the 30 to 40 cent range, 3 to 4 cent range. So there's good opportunity for customers to load shift around those spikes in the spot price.
Yeah, absolutely. I mean, those daytime prices are really quite extraordinary. Thanks, Alex. Let's jump into the forward market, cognizant of time. So the forward market probably more closely underpins more standard retail deals. As I said at the outset, there is obviously some feedback between the markets that one can drive the other and vice versa. But if you're looking at contracting and retail deals and wondering if last month was the right time to go for a retail deal versus this month, this should give us a fairly good proxy in terms of the month-over-month change. And what we're looking at here is the base load futures contract. So as published or as traded by the ASX Futures Exchange, a baseload contract, for anyone unfamiliar with it, is a block of energy for 24/7 for the entirety of the quarter, as it's listed there. Retail contracts are typically underpinned by calendar year blocks instead of quarterly blocks, but the average of these 4 quarters in the relevant year period would make up your retail block. Quite clearly, you can see the seasonality here between the different quarters. Q1, the highest price quarter in all regions, and prices falling away in the next 3 quarters of the year. And so that is a trend that seems to be getting more prevalent. The market expecting to become peakier, and that really is played out in the spot market data that we're seeing with the off-peak periods exceptionally cheap, particularly off-peak market times, I should say. Off-peak from a retail contract perspective is overnight, and depending on your region, may or may not be the cheapest wholesale prices. But in terms of that very high renewables times of the day, like the middle of the day, exceptionally cheap, but then more volatility or perhaps higher prices gouged back in the shoulders as generators look to recover those prices. But the contract market, what does it tell us? Basically higher in all regions over the last month. So anyone who sat out of the market waiting to contract retail load over the last month will likely be staring down the barrel of slightly higher costs. The gains have been probably most pronounced in New South Wales and Victoria, to a lesser extent South Australia as well, though traded volumes there are always somewhat lower. The gains further pronounced probably in isolation in the Q1 contracts. It's a little bit hard to see it on this scale, but the biggest difference between the 2 lines there from the 1st of July, 1st of June, sorry, to the 1st of May, you can start to see a little bit of white opening up in the Q1s, and that's really sort of consistent with the gains that we started to see in April as the market moved higher. Much of that value was coming in through the Q1 contracts, so summer risk being added back in or being perceived by the market, whereas the Q2s, Q3s and Q4s, they've moved up, but probably not to the same extent as the Q1s themselves. So we are looking at the market that's probably $3 to $4 a megawatt hour higher than where we started the month, depending on at a calendar year level, depending on which region you're looking at. Queensland, the gains have been much more modest, but still has been net higher month over month. And that is a trend that has continued into the start of June as well. So why the gains? Well, that does correspond fairly conveniently with what's happened in the spot market as the prices have moved up over the 4 weeks. Secondly, anyone who tuned into on the spot who follows the wholesale market would know that these prices are exceptionally low relative to where we came from at the end of last year. Prices knocking off sort of 40 to 50% of their value over the space of sort of 4 or 5 months. You probably also got a little bit of less concern around the impact of COVID as we've started to see restrictions ease, as the Australian conditions have presented as probably we're much more on top of it than some other countries around the world. Perhaps the implication when you look at share markets, when you look at the Aussie dollar, is not quite as concerning as it was 2 months ago. And lastly, you've probably also got some retailers coming in to buy contracts for their load that they've contracted over the last month or two with a 1 July start date. So those factors are likely to have contributed to the gains over the last month. The Q1s, I suppose, is always interesting, particularly, I suppose, in your world, Alex, where you're involved in the demand response programs and support customers to avoid those exceptionally short near-term or short-lived price spikes. We are seeing contracts in particularly the most volatile regions, arguably in recent years, Victoria, to a lesser extent South Australia, back up towards, you can see there, that Q1 21 contract heading back up to about $100 a megawatt hour. So that would be above where the Q1 20 settled. So premium, yeah, sort of charging back in there in those Q1s as yeah, I suppose people start to cover their upcoming summer risks. But yeah, $100 an average, $100 an average for a Q1 in Vic, probably not too bad going against history, given I think the highest it's been is like 165. So there's certainly further that contract could go, but be interesting to see what traders, how far traders push it over the weeks ahead, given we're coming on the back of a summer where prices turned out comfortably below those levels despite a number of days of volatility, as you well remember.
Interesting, the New South Wales futures are not sort of anticipating sort of similar levels of volatility, perhaps, as we just recently saw. New South Wales had a fairly volatile summer, although some of that was driven by bushfire-related contingencies. So the market doesn't seem to be expecting to see that again.
Yeah, and Queensland, obviously a number of years ago, extreme volatility off the back of various factors, including generator behaviour, but the market not seeing anywhere near that level of risk anymore, and so fairly modest prices out along the curve, comfortably below sort of at around $45, $46 a megawatt hour on an annual basis, so pretty attractive. That's kind of the key slides. I think probably in summary, we can say that overall wholesale prices in both markets are still exceptionally low. Some seasonal factors have come in to start sort of supporting spot prices a little bit. The contract market is recovering from its lows of April, probably some of that natural given how far the market had fallen, and for a few other reasons in there as well. But nevertheless, yeah, prices in both markets still appear fairly attractive right out into the forward period. Tend to agree, Alex? Or you think there's more downside or upside to come?
No, I think we're going to see prices start to climb back as we see demand increase, and somewhat a little bit as society returns to normal?
Yeah, so I suppose we'll open it up now to questions. So feel free to log your questions in the chat box if you've got anything specific that we haven't hit on so far. But yeah, you sort of hit on an interesting point there, COVID. Alex, certainly in the last couple of times you and I have jumped on this call a month or so ago and earlier, that was really the heightened focus. Pretty significant concerns regarding catastrophic collapse in demand as either restrictions take businesses out of action, or insolvency risk sees major industrial and manufacturing customers fall over and leave a hole in demand. We kind of haven't seen that, right? I mean, your data shows that demand is low, but not exceptionally low given the various factors that are playing out.
No, we certainly have never been able to see any very clear sort of coronavirus impacts on the demand. Nothing extreme is presenting itself in that sort of high level data. And certainly people's experience would be that things have, Australia moved pretty quickly, but things have not been as catastrophic impacts on much of the market. We even saw, I think, a lot of generators implemented their pandemic plans. They took actions pretty early, and we haven't seen any major problems with any generating assets or else. So that's significant that the worst did not come.
I think the other one to play out that continues to play out is probably through the gas prices, because of that linkage, that increased linkage through LNG export terminals to the global gas market and to the global oil market. Oil does become an increasingly important variable here, and this time a month ago, it was that oil prices, particularly the US WTI benchmark, had collapsed below zero for the first time ever. Prices have marched higher as supply side actions from various players, including that broader OPEC plus group, has looked to constrain supply and respond to that oversupplied global market. That's seen prices rally, and so I think we're up towards something like $40 a barrel in both Brent and WTI, the two major global oil benchmarks. And so that's pretty significant coming from where it was, and so that should play out in global gas prices as well, and potentially the LNG market. So it'll be interesting to see. I think that's the other factor. So demand probably hasn't collapsed like the doom and gloom fears, and now the oil market has recovered and potentially will tug up or pull up domestic gas prices progressively as well. So that sort of real pessimistic gas outlook, if anyone was thinking that the collapse in oil would absolutely flood the domestic gas market with really cheap gas, probably suggests that we won't see too much further downside for domestic gas prices at the moment, though the supply could still be good through the next few months. Now we've got a question here, Alex. I'll put you under the pump for a question from Richard. This came on the back of those duck curve charts. He asks, as domestic and grid scale storage is added into the system, how long do we think that the problems with daytime demand and variability in that system on the back of renewables, how long do we think it will be until that's solved?
Great question. I think the very short answer is it's quite a number of years away. The incredibly low cost of rooftop solar panels has really, accelerated the installation of those panels, which if we're talking about, duck curve behavior, then the rate of acceleration or the continuing acceleration of rooftop PV installations is going to outstrip any installation of battery storage for many years to come, because the cost of those battery systems are still quite expensive both on a residential and even a grid scale battery. Perhaps the other question on a grid scale battery, and we'll see this played out in the VPP projects, is to optimize the revenue earned from those batteries. They typically have to do a number of services, so that they're doing energy arbitrage, so buy low, sell high, simplistically, and then doing a number of ancillary services and network service support. Although the demand variability is very large, we don't necessarily see wild swings in pricing. So I don't think any number of batteries will just immediately cave into that hole, because the arbitrage opportunities don't exist in the same, they don't follow the same shape as the demand curve, or not linearly. So a number of years before that variability in demand will be solved.
Yeah, and I think an interesting tidbit is that the so-called super peak contract. So previously we were looking at baseload contracts, but a super peak contract is starting to gain a little bit of traction. Recently launched by one of the environmental brokers or electricity brokers as well in the Australian market, and basically that's a hedge that covers the highest price times of the day. There is about a 4 or 4.5 hour window that's covered in the afternoon peak in that contract, and in the Q2 and the Q3, so in the winter periods, or the notional winter periods, when you've got that double peak in the market, there's a couple of hours of hedge coverage that product provides in the morning peak as well. And so it's interesting to see where that has traded. It's not a particularly liquid product, but the implied non-super peak hours. So if you take out the hours that are covered by that super peak contract, you can work out what the market believes is the non-peak times priced at, based on who's trading it. And the initial trades have gone through, and really what they've shown is that Queensland daytime prices or non-super peak prices are trading in the mid to low $30 a megawatt hour for the CY21 next financial year or so period. And in New South Wales it's slightly higher, but you're looking at a non-super peak price of something in the low 40s, which probably is in the ballpark or within spitting distance of short run marginal cost, I suppose, of those black coal generators there. So that suggests the market still believes that there's probably going to be fairly cheap daytime prices, like we're seeing at the moment, pushing into 21 and to the start of 22 based on the tenor of those contracts. So yeah, the market still thinks that there's going to be depressed prices for now in those high renewable periods. A question from Chris, two Chris's. Am I sitting in my bathroom? Thank you for that question, but I am not. The glass background is a feature of my home, but I have had that question before actually. So I've had washing up there drying at one point in time. So it's also been confused for a laundry at one point. And another question, another Chris asks a question around, can we explain the 6 p.m. daily peak? And what our customers have done to try and avoid it. So that's probably coming to you, demand response lead.
Yeah, I can. Again, so I guess the evening peak is driven primarily by residential loads. So we see heating loads as people, we see general loads. So heating and cooking are probably the two big loads that drive residential consumption. And as people come home from work, or cook dinner, turn on the TV, start to do their sort of, finish work and do those kind of activities, then we see that spike. That's a consistent feature of demand all year round. It's just the rate at which it climbs during the year varies. So whether it climbs rapidly in summer or winter. The other thing that's exacerbating at this time of year is it's obviously down here in Melbourne, it's getting dark about 5:30, so there's no solar. So you're seeing an increase in residential demand due to behavior, and then you're also seeing less rooftop solar that actually covers that demand. So the behind the meter generation actually drops off. In terms of what customers do to try to avoid it, that is how long is a piece of string, but we encourage our customers through various, through our plans, through spot market exposure or that price efficiency factor, as you discussed, Aidan. And there are a range of energy efficiency or load management measures that customers can take to try to avoid using power at that time. So that could be shifting production times outside those windows. We see some factories working on 2 or 3 shift structures during the day. If those evening peaks cause very high spikes in price, and we'll call a spot responsive demand response event, and customers will typically switch off load or turn on backup generation. So there's quite a range of different ways that particularly industrial and commercial customers can take to avoid those high priced events in the evening, and consequently get much lower overall rates, average power rates.
Yep. And I think the other point to point out is that that was 1 week, that was one interval, and it was averaging $120 or $150 a megawatt hour. So yeah, unless your consumption is nothing and you turn on something specifically for that interval and then turn it off, you know, you're probably going to have very limited exposure, or the actual cents a kilowatt hour or dollar megawatt hour impact on your position is probably going to be fairly modest by that level of volatility. It's obviously the extreme stuff that happens in summer and ad hoc at other occasions. That's probably the bigger factor and the bigger concern for most consumers, because of that asymmetry in the market normally.
Yeah.
I think that's pretty good, Alex. We've chewed up 40 minutes. We've answered a few questions. Thanks for your time. Thanks for joining. On the Spot does return again next week. I'm not sure exactly what the topic is, but you and I will probably be back in a month if they let us back to review the month of June, hopefully, so we can see how some of those predictions played out and see what's been happening in the market. But yeah, thanks for joining. Have a good afternoon, Limo, and yeah, thanks everyone for joining.
Always a pleasure. Thanks, Ed.